Do you think things in the economy will start breaking if the Fed keeps rates higher for longer?
I do. I think that what we're seeing is a real height of consumer debt per person, of national debt in terms of not the overall level of treasuries, but the fact that the Treasury Department can't even rely on remittances from its own Fed, and the Fed's operating at a loss. These are things that have never happened in our history.
What are the major risks to the economy right now? Are we going to see distortions? Are we going to see specific opportunities in several asset classes that may see potential growth this year and beyond? We'll talk about these themes with our next guest, Dr. Nomi Prince. She's a best-selling author and geo-economist. We've talked about her last book, Permanent Distortions, which we can revisit again. Nomi was on the show 8 months ago, last summer. So lots has happened since last summer. Nomi, good to have you back. Thank you.
Thank you so much, David. Always a pleasure.
Always a pleasure to have you. Let's talk about first your book, Permanent Distortion. Some of the themes of that book are more applicable now than ever. We're seeing now, of course, asset prices having gone up to new all-time highs, although a lot of people have been skeptical about the growth of the economy and whether or not that's going to be sustained. So some concerns about how the real economy is distorted, disconnected, however you want to call it, from the asset market. What's your take there? What's going on?
Yeah, so what we've seen recently is a bit of a slowing down in, for example, US GDP this year. We just saw the print of 1.6% increase, which is not 3.4%, 3.2%, which it was. So there is a slowing down of economic growth. There's a massive increase of debt since the last time we spoke, David, which has created an expense, a monetary policy expense for what the Fed has done with its rate policy. So we're now in a pause situation with interest rates, but the cost of financing our debt, basically servicing our interest payments, is approaching $500 billion per year. That's a drag on the budget. That's a drag on the economy. That's a drag on the ability to actually create real things with real commodities. And this is very, very unique to an extent to the United States. This distortion between its monetary policy, debt increase, and what we're now seeing with a slowdown in growth in GDP. In contrast, some of the countries outside of sort of the Western Bloc, for example, China and India, are actually seeing turnarounds in their economic figures. They're showing less of a debt-driven economy, and they're also increasing their pull on natural resources for energy transformations, battery storage, and technological AI factory developments, as well as infrastructure building. So what we're seeing now is actually a global distortion amongst blocks of countries, I think, with respect to the trajectory of economies versus debt versus monetary policy and inflation.
One could argue, though, that debt has fueled this asset bubble, or if you want to call it a bubble, this rally. So, from an investor standpoint, we like debt, we like deficits. But when is it all going to start catching up to us?
Yeah, so from a standpoint of the fact that the Federal Reserve has been a buyer of our debt, for example, we've seen this massive increase in debt. We don't exactly know to what extent it has gone into the economy. It's definitely inflated markets, the fact that over the last year or so, there's been a sense that the Fed is going to cut rates or somehow go into some form of quantitative easing from quantitative tightening, period. So from that standpoint, even though we've had rocky periods, in the stock markets and in the Nasdaq and the S&P and so forth, we're predominantly much higher. Investors do like that. Investors like the idea that not so much that there's debt, but that there's a buyer for that debt, and there's a possibility of reducing the cost of that debt now, which comes from the Fed. That said, what the Fed just did in its last meeting is say that they're going to reduce the amount of debt that they let taper off of their books. In other words, to cut back quantitative tightening. What does that mean? They re-step in and reaffirm their role as a buyer, or at least a holder of a massive amount of U.S. Debt in both Treasury and mortgage, which link to Treasury assets. So this is a distortion as well. From an investor standpoint, it means that the Fed, regardless of what it says about fighting inflation with interest rate policy, still has a massive book of debt and is willing to pretty much hold on to that massive book of debt with some adjustments going forward, which means even though we're borrowing more, we have a buyer. That said, other countries are not buying as much of our debt, not on an absolute basis, and also not on a percentage basis. So we have just ballooned massively. And they have basically kept, for example, China, the same 1.1 trillion or so dollars worth of US Treasuries on their books. What does that mean? They're finding other places to invest, which are not in United States debt. And this goes back to what I was saying before. From an investment standpoint, yes, we've seen upside because of the possibility of all of this happening. But on the same token, we haven't invested in as much of our absolute growth, our actual growth. We've had factory development in the Midwest. We've had money come out of the CHIPS Act, $30 billion recently for chip manufacturing in the United States. All of these things are part of growth, but we've had massive underinvestment in infrastructure, from everything from falling apart bridges to roads to highways to communication systems to energy transformation systems and our power grid. So what this means is we're evolving into a period where we're going to have a even more slowdown in growth. And from an investment standpoint, we're going to have to be more particular about where we invest in products and in commodities that drive those products outside of the United States and not merely in the United States markets.
This comes back to some of the themes you wrote about in your book, Collusion, how central bankers rigged the world. Let's tie this back into your book and what you just talked about. So, everything that you've just discussed in the last 2 minutes, was this all part of some sort of bigger plan by the central bankers?
It's interesting, and thank you for mentioning that in collusion. The plan of the central bankers, I think, initially after the financial crisis, as I started in collusion and worked through the years past that in that book, was to basically calm down the markets. It was to sustain the banking system, do the bailouts, make sure that banks around the world weren't still being compromised by the risks that were inherent to the system, or at least not on their surface. Since then we've seen Credit Suisse go under, we've seen a lot of regional banks go under. Many things have happened since then which haven't been quite what they designed or maybe would have envisioned, but did sort of work in terms of they put out a lot of money for sort of created a lot of money for financial systems, and that money did go to its intended purposes. And of course, COVID, we sort of doubled down on that, particularly with the US and other central banks, to basically accommodate the shortfalls in just movement and economic movement, supply, and so forth. But I think right now we're at an interesting point where they're still trying to do the old playbook, but the rules around them have been changing, or the actual events around them, the supply chains around them have become less controllable. When it was just about money, when it was just about banks, when it was just about, plugging the holes in massive derivatives positions, that was one thing that the central banks could sort of get together and figure out a way to collude and control to an extent and to calm down. Now that we're in this period where it's more about inflation that I believe is connected to supply chains, to geopolitics, whether that's the Middle East and oil, whether that's Ukraine and Russia, and other forms of natural resources, wheat, grain, etc. All of these things are outside the purview of central banks. So what does that mean now? They're still trying to connect. They're still trying to have swap lines with each other and have rates, sort of accommodate where they believe they can tweak economies, but they can't control them. So that's why it goes back to my other point, which is now we're in this period where China's saying, you know what, we're going to be double downing on our infrastructure at home, lending to countries around us, augmenting our trading relationships with Brazil and other countries that are developing and have natural resources outside of us, building plants there. The United States is trying to figure out how to be competitive in that world. The mining and natural resource and energy and battery storage community is trying to figure out how and where those supply chains are going to be grown over the years. So for example, I was just in Brazil, and one of the big things there is growing its standing in rare earth minerals, rare earth elements, which are used in everything, from us conversing over this medium, through our computers to our iPhones to battery storage to EVs to space to defense and so forth. And they're trying to figure out, all right, well, how do we work with the rest of the world on what is a large stockpile of rare earths right now? And how does that play into economies? How does that play into a role between the US and China, allied supply versus competitive supply? So I'm saying a lot of phrases here, but really it's a very interesting transitional period in the world right now, both away from what central banks believe and can control to real things and where they're going and who's providing them and who's processing them.
I'd like to explore one of the themes you discussed in your conclusion, which is the shifting of global superpowers and ultimately how central banks will adopt to the shift. Can you summarize what you found for us?
Yeah, so basically what we saw back in the financial crisis of 2008, which led to collusion and this massive overreach of the Fed and other central banks in terms of printing money, buying debt, QE, and the like, is that other countries got scared, whether that's China, the EU countries, even though we have very strong alliances there from the US and EU countries, India and so forth, and said, look, if the United States can have so little control over its financial system, that all of these elements can coincide to create a big financial crisis, which can bring down an economy, and then you have Fed policy go to zero interest rates, you have a large amount of debt, you have buying of that debt, all of these sort of new elements to monetary policy that other countries just have to sort of abide by and be involved in because we have currency relationships and swap lines and banking relationships globally. And so that began this entire development of the BRICS and BRICS Plus nations to trade more with each other, not necessarily to create their own currency. That's something they continue to look at. And now with digitalization, it's something that's actually accelerating. I was just in Brazil talking about how the G20 is going to talk about digitalization, that's a hard word to say, and a global payment system, which is akin to our FedNow US payment system, and how that's going to work in terms of moving money quickly without a real currency backdrop, almost uber central banks around the world, even though central banks will be involved in controlling it. So there is this idea of collusion where other countries had to abide by US policy. They had to reduce their rates at the same time. They had to be involved in swap lines. They had to deal with banking systems. And over the years, though, it made them solidify their relationships with each other. And all of these years since now, we're going into 2024 from 2008. So we're talking about, 16 years here, 18 years of change in this period that we're seeing in the next couple of years. This is something that is going to continue that superpower shift towards China and its allies. When I say allies, I mean trading partners, debt partners, lending partners, extraction of mining and processing partners, into something that's stronger and stronger. India is a part of this as well. There obviously have relationships with us and China, but this has been happening, and now it is accelerating because of the supply demand chain and commodity pull. That's also part of where we're moving towards as general economic growth and technologies develop.
And I keep hearing, as part of this narrative of transition, that the US dollar will lose hegemony and that people will around the world start dumping the US dollar. What's your take on this? Have you looked into this issue?
Yeah, so it is interesting because what we have seen, particularly as the Fed has kept rates where they are and had raised them beforehand, that the dollar has maintained, for the most part, a fairly strong relationship to other currencies. But that is just merely from the standpoint of looking at baskets of currencies relative to baskets of other currencies, the dollar relative to the euro, dollar relative to the rand, and so forth. It doesn't really take into account where the growth in trading partnerships has been accelerating outside of just dealing with the United States. So areas in Southeast Asia and China working together, Japan and China working more together, Brazil and India and China working more together, and so forth. You've had this expansion of the volume of global trade across the world outside of the dollar. So in that respect, the dollar has actually lost value that doesn't come up when you just look at currency baskets and ETFs of the dollar exchange value. Now, is the dollar going to go away? No, but it has less of a percentage right now in central bank reserves. The Chinese have, for example, only been buying pretty much the same amount of US treasuries as before, yet we have a whole pile more of debt. So they're still at their $1 trillion number, and we're at, which they have held since we've been between 15 to now $35 trillion worth of debt. So their percentage of contribution towards our long-term economy has actually declined. So if we look at all of that together, we continue to see an eating away at the power of the dollar from the standpoint of economics, whereas the power of the dollar from the standpoint of geopolitics still remains, and as a currency from that standpoint still remains high. And I think we'll see more chips at it when the Fed starts reducing rates just from the sheer standpoint of exchange values, and a weakening from that standpoint. But it has maintained its geopolitical edge. in times of uncertainty that it has had. And that's why there's a lot of factors in terms of how it's shifting
You
to
said when the Fed cuts rates, not if. So it's a
yes.
matter of them doing it. It's just a matter of when. Do we have an estimate as to when they might do it?
Yeah, so
I
last
mean, no
year,
one knows for sure, but
true,
we can we can we can speculate. But yeah, I'm curious to get
right.
your speculation.
Yeah, so we do this a lot about the Fed, and that they help by being well, just feeding into that. Yes, I believe the Fed will cut rates this year. Last year, I think when we spoke, I thought that they would have some sort of a cut or pivot to monetary easing or accommodative policy in the second half of this year. So I still do believe that, and I believe that after what they said in December about potentially cutting rates as well. This year, I never really aspired to the idea that it'd be March or May or June even. I do see the possibility of a July cut. And I know that's becoming less and less popular, and I'd adhere to that simply because what we saw last time, and in the recent FOMC minutes, was that they made good on their promise to talk about reducing the pace of quantitative tightening. So instead of letting $60 billion per month of securities roll off their books, well, 60 billion of treasuries, 95 billion if you throw mortgages in there, rolling off their books, they cut down that amount to 25 billion per month. And what does that mean? It means, first of all, it's really expensive to service our debt. The Fed is losing money every single day because it is not receiving as much interest on the debt that banks are holding with it that it has to pay out to the Treasury Department. So it has something called negative remittances happening, and that's accumulating. So their book looks bad. We have a lot of debt. The debt payments that the country is making is large, and therefore they pivot a little bit more accommodatively on their quantitative tightening policy. That's why I think they're going to ultimately, in July or the following meeting, also pivot on rate policy. Now, Powell talks about inflation all day long, how it's not there yet. It's not 2%. He feels bad about himself. They can't, but the point is, they cannot control inflation. And the reality is, from a supply side perspective, whether it is in gas prices, oil, corn, wheat, coffee, chocolate, copper, silver, you name it, they literally have no control. Even in housing and rents, which are predominantly financing based, they have no control. Rents have only escalated. Housing's dipped a bit, but that's also a bit of a seasonal thing. They've really had no control over actual inflation, except from an incidental perspective, which is that inflation has somewhat gone down during the period, incidentally, I believe, with them raising rates. All of this, I think they need to process and will very soon, as they've already moved to a more accommodative process on their books. And I think what they're gonna say at the next meeting, if not the following one, or if not at Jackson Hole in August, is that the economy is slowing down. Powell did brush that aside at the last Q&A. He didn't really get into the fact that our GDP is now growing at 1.6% last quarter. But I think what's going to happen is they're going to look at the relationship between inflation and economic growth. They're going to see economic growth slowing down, the labor market sort of slowing down to stabilizing to staying the same, debt increasing, their losses growing. And I think that's going to create a rate cut, well, 3 rate cuts this year. I still think we're going to see that.
That sounds like a stagflationary scenario whereby
Yeah.
we have slower growth but higher inflation, but the stag part doesn't worry the Fed as much as the inflation part, correct? If we still get higher inflation, they're still mandated to kind of, work with that, keep rates high. No?
Well, their mandate never included a 2% band. And they've been very hesitant to back away from that band. Their mandate includes price stability. And they've been very obstinate about actually analyzing the relationship of price stability to a slowdown growth to what the cost of high debt is, and therefore just been focusing on inflation. And I think there will be more internal conversation, just like there has already been, and we've seen evidence on with their asset book about looking at other factors. Still going with the whole inflation's not where we want it, it's not 2%. All of that can continue, so they can sort of save face on that. It remains part of their dual mandate to control prices, but because they can't, And because other instabilities could arise because they can't, for example, a slowing economy or labor force, they do have the room if they choose to maintain or to reduce rates, but still maintain this idea that they care about inflation. That definition, that 2% number is basically, it's an artificially agreed upon number back in the Ben Bernanke days. It's not set in gold. It's not a law. It's something Powell has definitely, sort of held tight. But I think there's forces inside the Fed that may come to bear on that idea, because again, we can't actually control the price of resources.
Okay. Well, so you said the Fed has limited options. They have no control over inflation. What does have control over inflation, if anything?
Well, inflation is largely controlled, at least physical inflation, asset inflation, natural resource inflation, commodity inflation, by literally what's going on in the demand, or the constrictions to demand and supply in the world. I'm very much of the opinion that yes, monetary inflation is one side of the equation. Having M2 go up or down, that's something the Fed can control. Flow of money in the system, that is one form of inflation, again, of monetary inflation. But physical inflation, product inflation, resource inflation, is something I think we have to just realize is part of the mechanism of a world that is growing and is developing. What we've seen in the last figures, for example, with China, with the above 5% growth again. And that's a quarter, but it's pretty consistent without going down relative to where they've been. They require supply of commodities that they have a lot as well. They have lithium, they have different products, but they require commodities to build things. They require energy resources that they can't produce, that they import. So there's a global situation where you've got growing economies that requires resources, and they are going to be subject to supply and demand factors and change, whether that is more crisis in the Middle East, whether that, those are floods in right now in Brazil, or whether they come this, sort of again in areas of the United States or other parts of the world, whether that is ongoing conflict with, Ukraine and Russia, and whether that's ongoing conflict between Taiwan and China. I mean, there's just a lot of areas in the world that are involved in places where there are a lot of import and export of actual supply of commodities and those chains. And those are impacted by events.
Do you think things in the economy will start breaking if the Fed keeps rates higher for longer?
I do. I think that what we're seeing is a real height of consumer debt per person, of national debt in terms of not the overall level of treasuries, but the fact that the Treasury Department can't even rely on remittances from its own Fed, and the Fed's operating at a loss. These are things that have never happened in our history. And if we look at the retail, the regular person on the street, actually, retail is kind of, puts them in as a consumer perspective, but someone with real bills and real debt. There is a squeeze right now going on in terms of debt. And what happens when you can't borrow more because you can't afford to pay, or you default, or you go delinquent on the debt you already have, you break. That's the same thing with a corporation. That's the same thing with a human. Now, the United States isn't going to break because it's the United States and it can issue debt forever. But from the standpoint of person on the ground, their own buying power, I think what we're seeing is they have been strong, but they've been strong on debt. And you cannot be strong on debt forever. And when that does break, that's when consumption goes down significantly. That's when delinquencies go up. That's when these office space, these open office spaces and commercial real estate has another bout of negativity. That's when banks start to close and have more problems. So there is this potential redomino effect of debt being pushed beyond its brink.
Are you concerned about the labor market weakening at all in the US, at least?
Not at this point. Obviously, we've seen a lot of layoffs in various industries and from various companies. But if we look, it depends how we define the labor part. If I look at the department, the labor environment from the standpoint of someone can have multiple jobs and that counts in terms of payroll, and that counts in terms of employment figures. I think we are seeing, and we know that's the case, and that's not necessarily how the Bureau of Labor Statistics or even the Fed really looks at labor. From that standpoint, I think people are going to continue to be resourceful, and we're going to see some of the meta figures look good because of how people are involved in the labor force, how their participation actually is, rather than what it looks like at the surface. So from the standpoint of surface numbers, I'm not as concerned. From the standpoint of individuals being pushed to a brink, and then again, you throw into that debt and the financing hardships that can come from that, I do have a concern.
Okay. Looking around the world, geopolitical risks. So the Russia-Ukraine war has been ongoing for quite a while. Recently, though, provocative statements made from both sides have made headlines. So Russia says it plans to hold tactical nuclear weapon drills soon. This is in response to what the Kremlin believes are provocative statements from the West, provocative statements and threats of certain Western officials regarding the Russian Federation. The defense ministry the defense ministry said in a statement recently. Are things heating up?
I think they are, and I think part of this is political. Well, it's all politically motivated, but I think it's motivated by the fact that we're also approaching the November presidential election. And I think that when Russia in particular, when external countries perceive a weakness in anywhere, particularly with what they consider to be an adversary, and in this case, you know, the US and Russia relative to the Ukraine, that they basically increase those threats. I don't know that Russia's actually going to throw a nuke into Ukraine. But I do think that the intensification of these threats is related to the fact that we are paying attention to other things as a country. From the people perspective, we're paying attention to you know, so ongoing drama and trials and everything else. From the political perspective, you know, it's interesting, David. I was in Washington all of last week, and I was talking about infrastructure financing, and the idea that we need to basically repurpose our debt, not issue new debt, not create new taxes. But I ran a briefing in the House about that, and 15 different states were represented across the aisle at that briefing. But I say that because some of them are very concerned about signing up for a financing bill, even though it would mean no new debt, it's off budget and everything else in the quote political environment. So what is so you extend that into people are not really doing as much politically. We're paying attention to other things, particularly the election, and that provides a dangerous hole potentially for Russia or other countries to engage and to intensify their threats or particularly or, you know, potentially their actions.
It's not just Russia threatening to use tactical nukes.
Yeah, it's
Uh,
Iran. It's
yeah,
other.
yeah,
Yeah.
and the NATO actually they're responding with drills on the border in um operation called Steadfast Defender. They're launching drills of simulating a potential invasion of Russia should things really get out of hand. The markets seem to be discounting all this noise, though. Um, Stock markets aren't collapsing on these fears. In fact, it's going up. So maybe it's just noise.
It's interesting because I mean this is what on the ground they do have to take, you know, NATO and so forth, and Ukraine has to take these threats seriously. We have to take what's going on in the Middle East on all sides seriously, and the market reacts to actually is reacting to more sort of these monetary policy issues, and where am I going to invest money in terms of AI or semiconductors or gold or whatever else it might be in the meantime. But I do think we've seen a shift in the markets in terms of where some of that money is going, and I do think it is going into areas that could be squeezed with geopolitical or sort of international risk. Like I think we have seen more recently, you know, the commodities rising, and I think that's going to continue both from a economic standpoint of repositioning, like we discussed, but also from the standpoint of positioning into geopolitical risk. And I think we're seeing some more of that.
So, what are your preferred asset classes or sectors for this year and next? Positioning yourself for all the themes we've discussed so far.
So right now, I mean, I always keep an investment in gold and in silver and in copper in terms of the sort of precious metal wealth and industrial metal mechanics. Also nickel, also battery storage companies. because I think a lot of the technologies that are going to be driving our energy transformation going forward, and all the factories that are being even created for semiconductors, EVs, whatever you have, the data centers for clouds, all of that require not just more energy powering, but better battery storage. So I see that as an interesting area. And I think the commodities that drive some of our energy needs, uranium in the nuclear space, I'm still positive about, as all of the geopolitics and all the needs for energy between traditional and sort of alternative sources reside in the nuclear space. So I see that continuing to grow globally, and well-positioned uranium mining companies and processing companies to benefit from that. And also on the rare earth side, I think from the standpoint of looking at where we are going as a world, from a standpoint of economic and technological development, AI, and all of that, in our daily lives through defense of countries, we are going to have more need for the rare earth space. So I have been involved in looking at those, and getting involved in that area as investments. Right now, they're very attractively priced because no one's really paying attention. But I think that's actually, like it was with uranium a year and a half ago, I think a good opportunity to invest for the long term.
Well, thank you for your updates. We'll have you on again soon to update us some more. So I mentioned you have two books that we discussed so far, Collusion and Permanent Distortions. I'll put the links down in the description below. Are you working on something else right now? Anything we should be keeping tabs on?
Well, I am working on a couple of things, a major project that I'm going to sort of talk about in July and August. So if anyone wants to sort of get in touch with me on that, you can sign up to my email list. It's free, it's private. I don't sell it, through my website, www.nomiprins.com, as well as I'll be starting to work on a book that sort of relates all this sort of realness of commodities, commodity wars, the geopolitics of those as they extend from my other books, Dave. As they extend from following banks, following central banks, following repositioning of world players, and now looking at the needs of the supply, demand, real assets, and how those fill into our economic lives, our political lives, our geopolitical lives, and global growth.
Okay. Well, thank you very much, Nomi. Thanks again. We'll speak again soon.
Thank you so much.
Thank you for watching. Don't forget to like and subscribe and follow Nomi Prince down the links down below.